How to answer AFM paper part 4. So this video we are going to end this. We are going to go to the last question, question 3, and please pay attention to this question 3 because it's little tricky. Okay, so what I'm going to do is I'm not going to read this all, go through this paper because I'm assuming that you have went through this paper or you will go through, you can read the case study, but in short let me describe what the case is about. So the question is, the topic is mergers and accusations. So this question is from the accusation, right? And here it talks about two companies, Have and Strength. So Have is the company who has finance, who has lots of finance to invest, right? But they have limited experience in the industry, right? Where is the Strength company? The target company is the Strength company, right? They have highly skilled scientists. They have developed complex product, but they lack the fund to develop their innovative products. Okay, and the sector is it's in a biotechnology industry, right? Have company is a public listed company, and the target company Strength is a private company. So their main business is they operate in a highly technical and sophisticated electronic components for complex machinery, right? So that is the whole case. Now, but both the the company who is going to acquire the Have company and the target company, which is the Strength company, they have two different viewpoints to measure the synergy. How you're going to calculate the synergy benefit, right? The premium, right? How are you going to calculate the premium? So Have company is saying, so these are some financial information which they have been given, right? The current PE ratio of the biotechnology industry is given. Okay, let me highlight the important points from here, right? The current PE ratio of the biotechnology industry is 16.4 times, right? Okay, 16.4 times. And it has been estimated the Strength company's PE ratio is 10 times higher than this. Strength is the target company, right? However, it is thought that the PE ratio of the PE ratio of the combined company is going down to 14.5 after accusation. That is the PE ratio of the combined company, and the annual after-tax earnings will increase by 140 million due to synergy benefits resulting from combining two companies. So 140 is the synergy benefit, right? Both companies pay tax at 20% per year, and Strength company's annual cost of capital is estimated at 7%. Have company's current share price is 9.25 per share. The biotechnology industry's pre-tax return on capital employed is currently estimated to be 20% per year, right? And you can see that for the Strength company, they have given for the first 3 years, 2001, 2002, and 2003, and for Have company, they have only given for 2003, right? Before we go to that accusation proposal, yes. However, Have company is of the opinion that the premium should be assessed on synergy benefits created by the accusation and changes in value due to the changing in price earnings ratio before and after accusation, right? So Have companies saying that we have to go by this PE ratio, right? The premium should be assessed using the PE ratio, before and after acquisition. HAFCO is saying. And what is strength saying? Strength is saying, right? Strength company is of opinion that most of its value is its intangible assets. Therefore, the premium payable on acquisition should be based on present value to infinity of the after-tax excess earnings the company has generated in the past 3 years over the average return on capital employed of the biotechnology industry. So they are suggesting two methods, right? And they have also given you the acquisition proposal. They have, first one is only cash offer, second one is, right, cash plus shares, and the last one is cash and the bond, right? We'll go into detail later. So these are the three ways of acquiring, right? And you have to be very familiar. You must know. You must be very thorough with all the methods of acquisition. The way of paying, right? The payments. The payment could be in cash. It could be cash for shares. It could be share for share. It could be cash or a convertible bond, right? So all the three methods are here. So this is the best way for you to learn, right? So these are the three questions which is given, and it's worth 25 marks. A. Distinguish between different types of synergies and discuss possible sources of synergy based on the above scenario. 9 marks. It's a theory question, right? So that you will be able to write, but still we'll go through the answer. Okay, next, B. Based on the two different opinions, right, expressed by HAFCO and StrengthCo, calculate the maximum acquisition premium payable in each case. Third, calculate the percentage premium per share which Strength Company's shareholders will receive under each acquisition payment method. There were 3 payment methods, so under each you have to calculate the percentage premium per share and justify with explanations, right, which payment method would be the best acceptable to them, and it's worth the 10 marks, right? So first we'll quickly go through A because it's theory and you will be able to understand it, right? Okay. An acquisition creates synergy benefits when the value of the combined entity is more than the sum of the two company values. So they have just given you the definition of what is a synergy benefit. Synergies, right? Synergies can be separated into 3 types: revenue, cost, and financial. So they have briefly described in the first para itself, right? Revenue synergies which result in higher revenues for the combined entity, higher return on equity, and longer period when the company is able to maintain competitive advantage. Just see the way they have written, right? Just knowing the points is not enough. You also have to focus on the way they have written. Everything they have described very shortly. They haven't gone into detail, right? Whether it's revenue, whether it's cost, whether it's financial. So you also have to explain very briefly, right? And it has been explained in one para, the first para itself. Next, okay, cost. Synergies which result mainly from reducing duplication of functions and related costs and from taking advantage of economies of scale. Financial synergies which result from financing aspects such as transfer of funds between group companies to where it can be utilized best, or from increasing debt capacity. Yes, when you're having a bigger company, you can transfer the fund. The company which needs most fund, right? Suppose you are the company which you are already having a good amount of fund and someone is not having enough fund to innovate. So now they can use the fund of the company who is having the fund. So transfer of fund is possible because of acquisition. That is known as financial synergies. Now you also have to relate this to the scenario above, right? So let's go. In this scenario, right? In this scenario, the following synergy benefits may arise from two companies coming together. Financial synergy. So they're talking that in this case, what is the company? Have and strength. Yes, have and strength. They are going to experience financial synergies. May be available because strength company does not have the fund to innovate new products, right? I've told you the target company is lacking fund. So on the other hand, have has a cash resources reserves available, right? When you will read the first few lines, you will understand, right? It may be possible to identify and quantify the synergy based on the projects which can be undertaken after the acquisition but would have been rejected before, and their corresponding net present value. So financial synergies is easy to calculate, it's easy to quantify, right? Because it's with numbers, it's with finance. Furthermore, as the company increases in size, the debt capacity of the combined company may increase, yes, giving it additional access to finance. Finally, the acquisition may result in a decrease in the cost of capital of the combined company. Right? Now let's go to the third para, which is talking about the cost synergies. Cost synergies may arise from the larger company being able to negotiate better terms. Yes, the larger the company, the better you are to negotiate for better terms. And lower cost from their suppliers. Yes, and there may be a duplication of functional areas such as R&D and head office, which could be reduced and cost saved. Duplication of work is reduced, right? Functional work. Because it's better to have one R&D department, one head office, rather than having two separate. After the acquisition goes ahead, right, you'll be having one R&D. Both the teams, both the companies will be using one R&D. Therefore, the duplication of the functional areas, there will be no duplication, so the cost will be saved. Okay, so these types of synergies are easier to identify and quantify but would be more short-lived. Cost synergies are short-lived, yes. Therefore, if the markets are going to be positive about the acquisition, HAFCO will need to show where more long-term synergies are coming from as well as this. Now let's go to the revenue synergies. So that just see the way they're putting each into different categories. First paragraph, they talked about first they defined what is synergy, then they discussed about all the three types of synergies: revenue, cost, and financial. Go to the second para. Here they spoke only about financial synergies, how it is achievable, how they have achieved. And third, it is about cost synergies. And finally, the fourth is about revenue synergies. Right? So this is how you have to go about one topic. If you're explaining one thing, make sure that it is explained in one paragraph. And when you want to explain something else, another topic, it has to be explained in another paragraph, not in the same paragraph. So now let's go to the revenue. So revenue synergies are perhaps where the general potential for growth comes, but are also more difficult to identify. Yes, revenue synergies are difficult to identify, quantify, and enact. Why is difficult to identify? Because it's on the long-term growth of the company, right? So it's difficult to identify sitting down whether the company will grow or not. Cost and finance, you can see. You can check whether your cost of capital is reducing or not. You can check whether finance is available or not. For cost synergies, you can see whether there is a reduction in cost or not. Right? Immediately you can see. But what about revenue? Revenue is you are predicting growth, right? It needs time and you cannot predict it today. So it's difficult to identify, quantify, and enact, right? So good post-acquisition planning is essential for this synergies to be realized, but they can be substantial and long-lasting. Yes, revenue is about growth, so it's long-lasting and it's substantial. In this case, have companies management can help market strength companies' products, right, more effectively by using their sales and marketing talents. Have company has the sales and the marketing talents which strength company lacks, right? So each one can use their skills. Okay, the skills which is there in the have companies management can help the strength companies products to be sold, resulting in higher revenues and longer competitive advantage. R&D activity can be combined to create new products using technologies in place in both companies and possibly bringing innovative products to market quicker. So the services of the scientists from strength company will be retained to drive innovation forward. But this need to be nurtured with care since they had complete autonomy when they were the owners of the strength company. Now, before the acquisition, they were the owners, all the scientists and all. But now, care needs to be taken after acquisition. Because if they leave, then the company, right, the combined company is going to suffer a lot because they are the one who has the most experience, the scientist, right? They know how to make innovative, complex products. And finally, the final para talks about the challenge. The main challenge in ensuring long-lasting benefits is not only ensuring accurate identification of potential synergies, but putting in place integration processes and systems to gain full benefit from them. So just by correctly identifying potential synergies is not enough. If you want long-term benefits after acquisition, there have to be an integration process where the two companies integrate easily, and also there have to be a system to control them. This is probably the greater challenge for management. Yes, and when poorly done, can result in failure to realize the full value of the acquisition. Have company needs to be aware of this and make adequate provisions for it. They need to be aware because they are the one who's going to acquire, right? So that's part A. It could be written anyway, but make sure that you cover the financial cost and the revenue synergies and you talk about them. Now let's go to part B. Part B and C is calculations. Right, so part B is saying based on two different opinions. What are the two different opinions? Strength company is saying, right, that premium payable on acquisition should be based on present value to infinity or okay of the after tax excess earnings, and have companies talking about price earning ratio. So now we have to use both and calculate the maximum acquisition premium payable in each case. So let's go to B, right? So first we are going to use maximum premium based on excess earnings method, right? And then we'll see what is the maximum premium payable. So to find this excess earnings, right, you need to follow all these methods in the order, right? I have explained this already. You can check in my videos. If you haven't checked that video, I will be giving you the link in my description below, so you can go to my description and click the link, and then you will get to that video where I've explained this, right? The excess earnings method. So this is the formula. They have also given the formula here, right? Average pre-tax earnings. First you have to calculate what is the average pre-tax earnings, right? So average pre-tax company, which company? Which company? Strength company, because strength is the target company. You have to find out the target company, not half company. And earnings before tax. Earnings before tax is the first item. Average earnings before tax means you add all the 3 years earnings before tax and divide by 3, because it's for 3 years. So that means 397 plus 370 plus 352 divide by 3. Just see, that's what they have done here. And then they have got the average. Same way for capital employed, you have to do the average. Capital employed is, let me show you for one, and then for the rest is the same. Capital employed is your non-current assets plus current assets minus your current liabilities, right? Divide by 3 because it's average. That's why here it is 882 plus 210. This is your non-current assets, this is your current assets, and this is your current liabilities. Plus for all the 3 years, before dividing by 3, all the 3 years you have to do the same, right? You have to add your current and non-current assets and deduct your current liabilities and divide by 3. You'll be getting this answer, right? And then excess annual value divided. Excess annual value or annual premium is the same thing. So to get that, this is the method, right? Your average pre-tax earning, that is 373, minus your average capital employed, right, into the rate of capital employed. So average capital employed you already got from here. This one you are putting here, and this 20% is given in the question. You can check out. It has been, yes, this one. I have underlined the last sentence. Okay, pre-tax return on capital employed is currently estimated to be 20% per year. So that 20% they have taken here, right? Deduct that from the average pre-tax earnings and get the excess annual, or which is known as excess annual premium, which is 199.1 million. Okay, then you have to find after tax. Tax is 20%. So that's why they have multiplied by 0.8, because 1 minus 0.2. After tax annual premium, right? And you are getting this. This again, right? You need to find the present value. So present value of annual premium, assume perpetuity, right? Because they haven't given for how many years, right? So and they have also given to infinity, they have given, right? Present value, yes, I underlined present value to infinity of the after tax excess earnings, right? So after tax annual premium divided by cost of capital is 7%. That's why 0.07%. Let me take you where it is 0.7%. Just check here. I have underlined it, right? Strength company's annual cost of capital is 7%. 7%, and you are getting this. So this the answer which you get, that is the maximum premium payable in total according to this method. So whenever you get a question, it's very simple. Whenever you get a question like this where you have to calculate the excess earnings method, always follow this 5 steps. This method, this is the way, and you will get the answer. All these 5 steps needs to be followed in a correct order. First, you have to find the average pre-tax earning. Second, you have to find the average capital employed. Third, you have to find the excess premium. Fourth, you have to find after tax. And finally, the present value of that premium. So that will be your maximum premium. Next, let's go to the PE ratio, right? Strength company's estimated PE ratio, right? They have told that it is 10% more than the combined company's PE ratio. Not the combined company, yes. So the biotechnology industry's PE ratio is 16.4 times. Okay, so 10% higher than this is the strength company's PE ratio. That's why it is 1.1 into 16.4. So this is the PE ratio. 18 is the PE ratio of strength company. Now, strength company's profit after tax, right? You need the earnings. That's why you are finding strength company's profit after tax, because you just have the PE ratio. With that PE ratio alone, you cannot do anything. You also need the earnings or profit, right? So strength company's profit after tax, right? So what is the strength company's profit? Which profit you have to take here? Let me go up and show you. There are for 3 years. You have to take this one, 397 for the 2003, because here, right, you have to take this, because you are taking here 2003. Here also it has to be 2003. So the other 3 years are given just for you to calculate your first method, this one, excess earnings, to get the average. That's why the 3 years are given. So that is why this is 397 multiplied by 0.8, because after tax. And HEFCO companies profit after tax, right? So for HEF you are using this 1980, this earnings before tax. You have to find after tax, right, which will be multiplied by 0.8, because both companies are paying tax at 20%. Yes, so you are getting HEF company's profit after tax. You are getting the earnings for strength company and HEF company. Now you have to find the price to earnings ratio before and after. That's what was there, the requirement, right? Let me go and show you. Yes. So however, have companies of the opinion that the premium should be assessed on synergy benefits created by the acquisition and the changes in value due to the changes in the price earning ratio before and after the acquisition. That means synergy benefit by using PE ratio, right? So that's why we have to find the individual value companies and the combined company value, right? That's why we are doing all this, because we want to know the synergy benefit, right? So combined company, and you are having the individual company values of strength and have, right? So now what we are doing, right? We have to find the current value, right? These are the earnings, profit after tax. Now we have to find the current value, right? So have company's current value, right? If you want to find the have company's current value, okay, so here they have given have company's, okay, have company's current share price is 9.2 per share. What is the share? 600, right? It is share capital 600 divided by 0.25, right? That will be the number of shares, which is 2400. So that 2400 will be multiplied by 9.24 to get the value of have company. So that's what they have done, 9.24 into 2400. And for strength company, we are using the PE ratio already 18, and we have got the earnings here 317.6. So multiply the earnings by the PE ratio and get the current value, right? So now we can find the combined company's value. What is the combined company's value? Okay, combined company's value will be the value of the HEF company, right? Before you find the combined company's value also has a PE ratio, by the way. So you have to take the PE ratio. The combined company's PE ratio is 14.5. 14.5. PE ratio of the combined company would fall to 14.5 times after the acquisition, right? So you have to add both the earnings of the company, right? That's what they have done here. Combined company's value, right? 1584, this is the earnings of have company, and 317.6, this is the value of the strength company, and they have added 140. 140 is the synergy benefit. Remember in the question I told you to underline 140 is this 140 they are talking about. They are talking about this 140 million due to synergy benefit. You have to take the synergy benefit. So that 140 you have to add with the after tax earnings, right? Which is this, and then multiply finally by PE ratio, which is 14.5 to get the value. So the combined company's value is this. So now when you have to find the maximum premium is combined company value minus the addition of the two companies value, right? So this is the combined company's value. With this we are taking individual company values. This one was for have and this one was for strength, and you are getting this. So this is your maximum premium. And this is your maximum premium. Now let's go to C. What is C asking you to do? Calculate the percentage premium per share. So make sure that you have to first calculate per share before you get the premium, right? Which strength company shareholders will receive under each acquisition payment method, and justify with explanations. So you also have to explain theory. Which payment method would be the most acceptable to them? This is a little bit long, so make sure that you follow with me, otherwise you will miss the whole picture. It's very important that you go line by line with me, because this is a very tricky part, right? And once you're good with this, I bet you that you are in a high position to pass, right? You are putting yourself in a very safe position to pass this paper if you are very good in this. So strength company's value per share, right? Strength company's value, we have just taken it, this, okay, so the strength company's current value is 5716.8, this one, right? But we don't, that is the value, right? But we want to know the number of shares. Number of shares is very easy, just take from here, right? It is this 300 divided by 0.25, it will be 1200, right? So that means 1200 shares are there, divided by 1200 share, that means 4.76 per share. Let me highlight this because you will be using this information throughout. So this is their current value per share, right? Now this information, these two lines, right? You don't use it now immediately, you will be using it later when you are explaining your theory part. So that's why let's calculate it. right? So the maximum value percentage based on PE ratio and based on excess earnings, the two methods. So based on PE ratio, right? This is just your premium divided by your total value, your current value, I mean. So this you have already calculated it. This is your maximum premium. Yes, this 1710.4, right? Based on PE ratio, divide by 5716.8 because that is the current value of strength. For both it will be same. The denominator will be same, right? And maximum premium based on excess earnings. What is the premium used based on excess earnings? This one, 2257.7, and you are getting a very high percentage for the second one, right? Just leave it for now. We'll be using it later. Let's go. There are three offers. First one was cash offer. So based on cash offer, let's again go to this table, accusation proposal, right? So let's only focus on the first part, I part. Don't look the other two. A cash offer of 5.72 for each strength company share. So now you know how much each strength company share is worth. That is, we have calculated it. 4.76, right? Right. So with this only you have to compare. So the cash was 5.72 per share, right? And the current value per share is 4.76, right? Divide by 4.76 because you have to find as a percentage, right? So you are getting this. This 5.72 is the cash, right? 5.72 per share minus 4.76 because the value of the company is the share is 4.76, but you are offering a cash, so you have to find the difference. To know the premium percentage. It's like a premium because your share is worth 4.76, but you are offered to pay a cash 5.72, which is more than the value. That means it's a premium, right? So that premium percentage only we have to find. So that is the whole point. Now let's go to the second one. Second one is cash and share offer. Let's again go to the requirement and read it very clearly. What is it about? A cash offer of $1.33 for each strength company's share. Okay. Let me put a comma here, small comma, so that you can separate it very clearly, right? Plus, okay, this is addition to that, plus 1/2 company share for every two. 1/2 share for every two strength company share. Right? This requires a little bit of work because you have to work with the half company's shares. Here, right? So 1/2 company share for two strength company share. How much 1/2 company share is worth? It is already given in the question, 9.24, right? So that means for one share, right? 1/2 company share for every two. That means divide this by 2, half of this, right? So per strength company share will be 4.62. Because 9.24 is for two shares, two strength company shares, but for one strength company shares it will be half of this, 4.62, right? And the cash payment per share is 1.33, right? It has been given in the requirement, 1.33 per share. So what you have to do is add this both. You just have to add, right? The cash part and the share part. So 1.33 comes from cash and 4.62 is the share. You are getting 5.95. Even this is excess to 4.76. This 4.76 is, right? This 4.76 is this one, right? Current value per share. This only you will be using throughout the answer to find the difference, to find the premium. And you are getting a higher premium than the first one, right? Here you are getting 20.2, here you are getting 25. Let's go to the third one. Third one is a little tricky. That is the most challenging one. Most trickiest is the third one. You need to be very alert, you need to be very aware, and you have never gone through your textbook, right, from your textbook of such a kind of question. That's why I had to do this paper. So let's go to the third one. And yes, third one you might have to read several times because it is so confusing. When I tried to do first time, I was like, oh my god, what is this? Okay, so follow me. Third one, a cash offer of 1.25 for each strength company share. Let me put a comma. So 1.25 cash, 1.25. This is easy. Go to the next part, the bond part. Plus $1.100 3% convertible bond for every $5 nominal value of strength company share. Right? So in 6 years, the bond can be converted. So this is a convertible bond. The bond can be converted into 12 half company shares or redeemed at nominal value. Right? Most of you must have not understood by now what is this 5, what is this 3%, what is this $100, $5 nominal value, right? No worries, we'll slowly go through this. Let's go to the answer. Yes, okay. So here, each share has a nominal value of 0.25. From where they got the 0.25? From here. 0.25, right? So this is the nominal share. Nominal. So each share has a nominal value of 0.25. Therefore, $5 is 20 shares. Right? They have given us $5 here. By the way. 5, okay? For every $5 nominal value of strength company share. Right? $5 nominal value of strength company share they have given in value terms. They didn't give you the number of shares that you have to work out, right? So you have to do a little bit of working here, and this is what you have to be always alert. You cannot work like a robot all the time. You cannot be mechanical. Little bit you have to think outside, little bit you have to be a smarter, right? What does it mean? So they haven't given the number of shares. You have to find the number of shares. All the things are not direct. You will never expect such things, right? So 5 is the nominal value, right? And per each share has a nominal value of 0.25. That means $5 will be having, that means 20 shares, right? So now what will be the bond value? The bond value is $100 divided by 20 shares. That means 5 per share, because whatever it is, we always want to find per share, right? Because even our current value of strength is given as per share, and it is given premium per share. We have to find the percentage of premium per share. So make your answer to per share. So that's why even though the total value of bond is $100, you still need to find per share. That's why we are finding this 20 shares to get this per share. And to get this 20 shares, we have to do this working. All this working we have to do. The first working we have to do, right? All this first line working we have to do to find number of shares, because if you get number of shares only, you can find bond value per share. That $100 is the total bond value, but we want per share. Again, let's go up and check and read the sentence, reread the sentence again to see whether now you have understood or not. Okay, a cash offer, forget about the cash offer, that you will be able to handle, plus $1.100, only $1.100 3% convertible bond, right? So that means the total bond is 100 for every $5 nominal value of strength company share. Indirectly they are saying for $5 nominal value, that is the value of the bond, but they haven't given you the number of shares. So just by using 5 you cannot find per share in per share terms, right? So now you have found that there are 20 shares. So 100 divided by 20, 5 per share. 5 per share. Now the cash payment is 1.25 only, right? So just add, that's it, the bond value and the cash payment, which is 6.25. And now the rest all you will be able to do it. And just see that this is giving you the highest premium, 31.3%. So now let's go to the theory part, and make sure that you go through this theory part. So I'm going to take you through this theory part because it's very, very important. I know it's very tricky and it's very important that you have a proper knowledge. That's why I'm taking you through. Otherwise, I would have given it to you to go through. But since this is a little bit tricky and most of you will be having doubts, I don't want you to go to an exam hall with doubts and all. I want you to be clear cut. Everything has to be very crystal and clear, right? So let's go. Okay. On the basis of the calculations, the cash together with the bond offer yield, that means the last option they are talking about, right? The cash together with the bond yield offers the highest return. In addition to the value calculated above, the bonds can be converted to the 12 half company shares. Yes, they have also told that the bond can be converted to the 12 half company shares. If you convert into 12 company shares, if they take that option of converting, what happens? Giving them a price per share of 8.33. Why? Because the bond is 100 and for 12 shares, so it will be 8.33, right? This price is below half company's current share price of 9.24 and therefore the conversion option is already in the money, right? It is probable that the share price will increase in the 10-year period and therefore the value of the convertible bond should increase. Right? A bond also earns a small coupon interest of $3 per 100 a year because it is coupon at 3%. Remember, it is a 3% convertible bond. So that's why they will earn a small coupon interest of 3 from that 100. So the 31.3% return, this is this premium they're talking about. It's the closest to the maximum premium based on the excess earnings method and more than the maximum premium based on the PE ratio method. That's why I have told you to calculate this two method. This is the reason I've told you. Now it is 31 point what is the percentage? 31.3%. So 31.3% they are saying it's close to the second this one excess earning 39.8%. But this 31.3%, right, this premium is more than the maximum premium of the first one using PE ratio, right? So that's what they are saying here. The 31.3% return is closest to the maximum premium based on the excess earning method and more than the maximum premium based on the PE ratio method. It would seem that this payment option transfers more value to the owners of the strength company than the value created based on the PE ratio method, right? They are saying the third option, if we are using, then more value will be transferred to the strength company than the value which is created based on PE ratio method, right? So now because of course you can see that this offers the highest percentage, and if you are using the second one which is 39.8, right, it is giving a higher return, higher value to strength company, right, because the premium amount will be going to the strength company, right? So the strength company is the one who's going to get benefit. He's going to get benefit most by the second method, by the second one, excess earnings method, right? Then the PE ratio. So that's what they have explained here. However, with this option, which option? Third option, cash and bond. Strength company shareholders already receive an initial cash payment of 1.25 per share, initial capital only, right? So initial cash payment 1.2 share per share compared to 1.33 per share and 5.72 per share for the other methods. You see first method it was 5.72 per share, second 1.33, but this one 1.25. That means in terms of cash is very small. So this makes it this may make it the more attractive option for the have company shareholders. Why have company shareholders? Because they have to pay less cash, right? 1.25 as well. And although their shareholders will be diluted most under this option, it will not happen for some time. Have you understood this line? Whose shareholding will be diluted? Have companies. Why? Because have companies giving a convertible bond, right? And that convertible bond can be converted into have company shares. So that means 12 of have company shares will be taken by the strength company if the bond is converted to shares. So that means the shareholding of have company will be diluted by using cash and bond. But it will not happen for some time. It will not happen immediately. But after 6 years, when the bond will be converted to shares, if it is exercised, at that time it will be diluted. And the cash and the share offer, that is the second, gives a return in between the pure cash and the cash and the bond offer. That means second is in between the first and the third method. Although the return is lower, strength company shareholders become owners of have company and have the option to sell the equity immediately. Even though the return is lower in the first one. Which one? The cash. Right? Strength company shareholders become owners of have company. Why? Because they are getting cash. Right? They are just paying cash and then they what? Then they become a part of have company and have the option to sell their equity immediately. This is cash and the share issues. So I'm sorry, the second one, cash and share, right? So they are taking have company shares and they are becoming owners and they can then sell their equity also immediately. However, what happens when they go for the cash and the share? However, the share price may fall between now and when the payment for the acquisition is made. If this happens, then the return to strength company shareholders will be low. Yes, when the share price goes down, the return which strength company will get will be lower. And finally, let's go to the pure cash, the first method. So the pure cash offers gives an immediate and definite return to strength company shareholder, right? Why immediate and definite return? Because you are very sure cash, right? Immediately you are paying cash. So immediately means you are getting the result also on the spot. Definitely you are getting the result because cash is received, no risk, nothing. Everything is clear, right? But it is also the lowest offer. Exactly, it was 20.2%. And may also put a significant burden on have company having to fund so much of cash. It will put a burden because it was 5.72 per share, the first method. So that means so much of cash have company needs to borrow now to fund this acquisition, possibly through increased debt. And finally, let's go to the last paragraph. It is likely the strength company shareholders or managers who will continue to work within have company will accept the mixed cash and bond offer. It is likely the strength company shareholders will accept the mixed offer. Why? That is the highest return they are getting, 31.3%, right? Because you also remember they also asked that you have to choose which option is the best. So at the end, the last para, you have to tell. If you don't, then you're not answering the requirement and you're not getting those marks. So make sure you say which option is the best out of the three. Like which option will be most suitable for strength company shareholder. They are likely to accept. They therefore get to maximize their current return, yes, and also potential gain when the bonds are converted into shares. So they are going to get two ways. First, they are getting the maximum return. Second, when the bond are converted to shares, they are gaining there. So different impact on shareholders. This line, right? Okay, it's good if you put this kind of lines. So different impact on the shareholders' personal taxation situations. Due to the different payments method might also influence the choice of method. Because when you pay cash, remember that you have to pay tax immediately on the cash. But when it's for share you don't have to pay tax. No cash is taking place, right? Already share for share. It's like a paper. On the paper only the shares are changing, right? Whenever cash is involved, tax also comes into the picture. So even though, right, you say that the first method is more suitable because it is the lowest this thing for the have companies, from the have companies perspective, right? Still they have to pay a huge amount of tax because it's 5.72 per share, the cash, right? If you are choosing the first method, only purely cash method to acquire, that is not suitable if you are taking, because then you have to pay a huge amount of tax. So in that case, if you are taking taxation into account, the third method which we have just selected is good because you don't have to pay tax, because it is, you have to pay tax but it's less because cash is less, right? 1.25. But for the bond part you don't have to. So that's it. Finally I've ended the specimen question paper. I have went through all the 3 questions from 1 to 3. First question was about exchange rates. We talked about currency risk, interest risk, agency issues, ethical issues. Second question was about net present value, adjusted present value, right? And this finally the third question is about mergers and acquisitions. So I hope that by now you are very thorough, very clear with all this in all these areas you need to revise, right? So that's it. Don't forget to subscribe to my channel. Hit the like button, comment below if you want me to upload videos on any question papers, on any past papers, relevant past papers that you think it would be beneficial for all, then let me know in the comments below. Thank you for watching. Take care.